All right, part 4. You want to build rental apartments. Where do you start? Well, it starts with a portfolio analysis, and that's the plan for prioritizing apartment development. Okay, so how do you get started on a portfolio analysis? Well, if you've got 10, 20, 30 shopping center sites, these are for the larger shopping center operators, I think you got to focus in on each site and look at the same data for each of them, and now that's going to allow you to rank the site as to which is going to be has the highest probability for success. So you're going to look at things like growing population, the densifying, the urbanizing of the neighborhoods. Which way is the neighborhood going? Is the income going up, down? Population going up, down? Rising income. Where do you have your excess land? Where's their proximity to transit and things like that? Okay. So on the next slide, we want to show you the portfolio analysis that we're going to do. And so if you could imagine a giant spreadsheet, okay? I think what I'm saying is that you want to have these columns of information where first off you have the site information. We're going to get that from you. That's the size of the site, the kind of retailers you have there, how much land you have, how much parking you have. We're going to determine how much land can be and where on the site can be kind of partitioned to build an apartment building on. Okay, so now we've got all our sites listed and listed maybe by size or geography. Then we're going to get the CMHC data, and we're going to talk about how that data from both CMHC and StatsCan tells you about the site. So which is the site where there's the highest rents in the neighborhood, where the incomes are the highest, where the population is stratified so that they're ideal renters, right? Then we're going to talk about the demand in each of those areas, and the demand based on how many apartments there are there, and a number of other factors, as well as the rent that we believe you can achieve. Now, the next column over talks about the building type. So if you've got suburban land far out, you're not going to build a high-rise there. It's just not going to work. We might be recommending a 4-story wood product, or a 6-story steel, cold roll steel and precast, or a 10-story precast building, right? So what you build on every site is really determined by the value of the land, not necessarily what you think you want to build or what the zoning allows. It's what's going to pencil out at the highest return. Then we calculate the value of the residual land based on the construction cost of the project that we pick. So you have 100 units of 6-story building with cold roll steel and core slab. We know what that cost is. We know what the rents are. We know what the operating costs are. We can back in to the residual land value. And then we can also calculate what your development yield is and what your profitability would be if you sell it. So that's the high level. Now, so when we look at your portfolio, okay, next slide, Julie. When we look at your portfolio, what we want to do is we want to identify the sites for intensification based on key indicators. So the first thing we're going to do is we're going to rank them in order of profitability, right? What's going to make a site profitable? If you've got 20 sites, which is the one that's going to give you the highest return? That's the one you should start in, okay? So which market, number one, do you feel comfortable in? And second, what built form do you want to focus in on? So if you have experience building, in your condo business, let's say 4-story wood or 10-story precast, then let's not do your first building as a high-rise, right? That's not where your comfort zone is. Let's do it on a geography that makes sense for you and on a built form that makes sense for you. Okay, so on this last table, what I'm going to show you is sort of what this looks like, and we can zoom in on this a little bit. So what we're going to do is sort of give you the property name, a description of the property, and then the built form that we think you should be building on that site. So can we zoom in on this a little bit? So the build form is the 4th column over. So here we're saying build, 4-story wood. And then we're going to give you the unit mix we think you should build of 1s and 2s, the average sizes, what we believe the rent is, what the parking is, and what the total rent would be, and then what the expense ratio would be. And we take all these assumptions now and put them into a model, and now we can generate a profitability for this proposed apartment building at a high level. Once we've done this analysis for you, we've now been able to determine which properties are ripe for apartment development. Now, next slide. So apartments really are the best way for you to monetize the value of your land. So if you're a programmatic shopping center owner, you get to monetize your land and you get to diversify your business and start taking advantage of all the benefits of apartments. Stability, investor demand, low interest rates, and maybe construction costs coming off, right? If you're a real estate family that owns retail, look, retail is an active business and it goes up and down with the economy. Apartments don't. Apartments are recession proof, and that's been proven over and over again. Apartments are probably the best way for you to generate wealth for your family and transfer it from generation to generation. Okay, we're getting to the last slide. So why do you want to build apartments? Well, number one, it's wealth preservation. It takes a fair bit of money to build an apartment. In the capital stack, $100 million, you can get a $75 million construction loan, maybe $10 million of mezzanine financing or $15 million of mezz financing, and then you need $10 million of equity, but that may be the land that you already have, right? But apartments are about protecting the wealth you already have, and the land you already have has a value to it. Next, it's about tax deferral, and typically you won't pay any tax on an apartment building for probably the first 5, 6, 7 years. And then the last thing is cash flow. And remember, apartment interest rates are probably the lowest of interest that you can find on any institutional type product. So what we like you to do is to consider joining Apartment Developer University. Okay, the program is on our webpage, svnrock.ca. There are short snippets there of previous webinars that we've done, so you get a good feel for the type of information that you're going to get. And our objective is to turn you, the shopping center developer, into an apartment scientist. Okay, we're going to teach you everything you need to know about apartments to add to that knowledge base that you already have. Thank you for joining us.